Hey there, we were asked to put this design together for you so you could take a look at what a tax-free design for a 45-year-old, our premium finance analysis. Let me start going through the premium finance scenario. I'll come back around to the top. And let me start at the bottom. From an illustrative perspective, in 15 years, you can begin to take $175,000 a year, income tax-free, out of this structure for the rest of your life. We have this going all the way through age 115. So that's 70 years from where we are today, taking $175,000 a year income tax free out. So a couple things to look at. Columns 3, 4, 5, 6, and 7 are life insurance policy information coming from the life insurance illustration. For a 45-year-old male, standard non-tobacco, for a $5 million death benefit, the IRS maximum allowed premiums is $335,445 per year for this particular policy for 10 years. $335,000 a year for 10 years. So we're going to get a bank in column 8 to finance those premiums on your behalf. $335,000 goes in year 1. The policy value at the end of year 1 is projected to be $280,000. The difference between the 335 and the 280 are policy charges, fees, and expenses. So all of the fees are already baked into the design looking at policy value. Column 6, cash surrender value, is the portion of the policy that the lender is able to take as collateral for the loan that they're going to provide you. That is their 30 days same as cash value each and every year in the policy. And then column 7 is the death benefit, the gross death benefit of $5 million plus the policy value of $280, which is why it says 5.28 at the end of year 1. And then we've got loan details. So columns 8, 9, 10, 11, 12, 13 are bank lending information. So again, the bank is going to finance the premiums of $335,000 a year. The bank's also going to finance the interest in column 10 every year. Now, when you add the premiums plus the loan interest, that's the total loan outstanding. In column 12, which in this example is an out-of-pocket expense of 10% of the premium, we show you paying down the premiums and the interest that the bank is loaning by 10% of the premium amount, or $33,000 a year, which gives us an end-of-year loan balance. End-of-year loan balance in year 1 of $321,000 minus the portion of the policy that the bank can take as collateral, which is the 30-day same as cash amount, the cash surrender value, equals a gap or a shortfall of $232,000. Now that's the amount that you would need to pledge in cash equivalents, marketable securities. If you have marketable securities, we can get a control agreement against the brokerage account where that's held, or a letter of credit from your bank if you have other assets that they'll take as collateral for that. Now, the column 15 net death benefit of loan is taking column 7, the death benefit plus the policy value, that $5.2 million, minus the outstanding loan balance in column 13 of 321. 5.28 minus 321 is $4,958,000, income tax-free, estate tax-free if structured properly, to your beneficiaries. And if you died in year 1, that's a 14,000% IRR. Based on the amount of money you've paid out of pocket. Now we do that every year for 10 years. You don't have to pay $33,000 a year every year for 10 years. The more you pay, the faster collateral goes away. The less you pay, the longer collateral stays in play in column 14. But that's a decision you get to make every single year. And then all the way down to year 15, outstanding loan balance of 4.6. We're going to show you taking a distribution from the policy to eliminate that bank loan of 4.6, which then allows you to take those distributions of $175,000 a year income tax free for the rest of your life. And again, that $175,000 is all the way down to age 115. If we take that from a actual out-of-pocket standpoint of how much money you've paid out of pocket, let's see, by the time you take your second distribution of $175,000, you would have recouped all of the money that you would have paid. In total, you paid $335,000 out of pocket, $33,000 a year for 10 years. The first distribution of $175,000 leaves $160,000 of your money. The second distribution of $175,000 means in 2 years, you've gotten all of your dollars that you put in back, and now you're living off of the money we created out of thin air using bank financing in this life insurance policy. By the time you're 80 years old, you've taken $3 million of tax-free distributions of money that wasn't yours, right? By the time you reach age 90, nearly $5 million of distributions you've taken out. Not to mention the death benefit sustaining of, nearly $5 million. So it's not something to keep in mind, right? And comparing that to the alternative, the traditional solutions, you can do term insurance. A 10-year term insurance policy will cost you $6,500. A 20-year term insurance policy would cost you nearly $11,000, or a 30-year term insurance policy would cost you nearly $20,000. But as you've heard me say, if you watch some of my videos, less than 2% of all term insurance policies have ever paid a death claim, meaning 98% of all term insurance policies, it's just the cash rate for the insurance company, which is why our clients and why you got referred to us look at permanent policies. But even a self-funded policy, to match the same $175,000 distribution that we're proposing or illustrating in the 16th year, you'd have to put in $145,000 a year out of pocket for 10 years, $1.4 million of your money, compared to the $33,000 that we're proposing and a little bit of interest. So this is what we wanted you to look at. If you have any questions, let's set up a time to discuss this further. This is completely customizable to your situation. We can change the size of the policy. We can change the loan premium payment or the loan payments in column 12 that you're making. We can talk about column 14 collateral and what you want to have available. But this is probably the most efficient design you'll ever see when it comes to insurance policies and financing those premiums. Hope you like it.